All right, I have 2 o'clock, so we're going to go ahead and get started. We're going to be a fairly small group today, which I think is good, especially for this topic. If you have questions, please use the chat to submit them, which should be down below. I'll submit a hello in there so that you can find that. It should pop up on you. This is being recorded, and so you'll get a follow-up email with this and the slideshow. Likely in the next couple days, just so that we can get it edited and sent to you. If you have, I already said the questions, so let me just turn it over to Raynor, who's going to present on developing projections for sales and revenue.
Yeah, everybody's favorite topic, yeah. So thank you all for joining us. I know it's beautiful out, one of the first real beautiful days we've had, so certainly appreciate you taking the time on a sunny afternoon like this to join me as we go through what can either be a really exciting topic or a relatively boring topic, depending on your comfort level with Excel and numbers. I'm going to try to keep it as straight and to the point as possible. Like Jen mentioned, the chat's available if you have questions, but it is a small group, so I'd also invite you to just unmute yourself and ask the question. If it comes up, I'd rather have kind of a discussion around the topic and make sure it's as pertinent and helpful for you as possible, especially with the small group that we have. So Jen covered most of this. My information is going to be available at the end as well, so that if you do have any questions or want to refer back to the slideshow or something comes up, just reach out. So today we're talking about strategies, right? Not certainties. I don't know about you, but the last year has been a bit of a surprise. 2020 did not end up where I expected it to end up with any of my projections or expectations. And some of that uncertainty certainly carries forward. So we're going to talk about greater strategies with projecting revenue. And we're going to focus on 2 things primarily. One is using historic data to project forward, so basing it on a trend line or an expectation of continued past performance moving forward. And then the other is kind of a zero-based approach where you're starting from scratch, where you're applying a change and trying to measure an outcome. So strategies, not certainties. Again, really reiterating that. One thing that we want to start this topic with is really identifying your audience. Right? So if you're presenting projections and you're targeting a lender or an investor, then your goal is really going to be under-promising and over-delivering. Right? You want to make sure that what you're providing to them is sound and achievable, because that's the last thing you want to do is shake their confidence in you moving forward by missing those projections. You also want to make sure that they're reasonable, right? Now, if you're providing these projections, if you're working through this and putting them together for yourself or for employees as a benchmark, then it can be more aspirational, right? So I think right from the start, one thing to really identify is, why are you doing this? Right? Is this to present to someone, to convince them to invest in your business or to lend you money? Or is this to set a goal and really hold yourself accountable and strive to achieve something greater than you've done in the past? So let's talk logic for a minute. So we're going to really look historically at first to look at your trend line. Right? It's kind of the first law of physics. Right? Is an object at motion or rest stays at motion or rest until acted upon by another force. So what we're really doing is we're looking back and we're saying, okay, where have we been? Where are we? And where are we going? Right? That last part is what we're going to be focused on. And there's 4 ways to project that, where are we going, right? So the first is documented. That's the easiest, the most straightforward. If you have a contract in your hand that promises a certain amount of revenue a month or a period, that's easy to project. You know when that money is going to come in, you know what that amount is going to be. So as far as projections go, it doesn't become, it's not easier than that. Now the second one we'll look at, the second and third really, are a little less reliable, but it's on that historic trend line, right? So we're going to look back at prior years. I'll show you how to kind of project that forward and adjust for seasonality. That's the historic. And then relative is a trend line that relates to another revenue line. So often we'll see a service contract, right? So if 5% of your jobs come with a service contract, then that service revenue line wouldn't really be projected by itself. It would be a 5% adjustment to your primary revenue stream, right? So any upcharges you do, if you sell, a warranty, or if there's some kind of connection between one revenue line and another, we'll want to understand that relationship and project based on that relationship rather than as a standalone value. And then the last way to kind of look forward is that zero-based, your guess is as good as mine, idea, where you're saying, okay, this is a startup, right? This is something that's new, that's innovative, that's creative. What is it going to be, right? And that's the least reliable way to project, but I'll walk you through a couple strategies as we get to that point. So this is I'm using Excel to put this together, and I'll walk you through these equations and the logic behind it. You can also use Google Sheets or whatever Macintosh uses, but the idea here is that I'm using a calculating tool because as much as I like to talk about math, I'm not actually that good at it. So I use a tool that does it for me. Right? So each of these are the four that we kind of talked about just now, right? So documented, that contract. If I have a contract for $10,000, it's very easy for me to say, my expectation, is that $10,000 is going to come in from that. Right? What I've done here is I've got four revenue streams. I've got my sales, my service, a commercial agreement, and warranty deeds, right, or warranty. I have 2018, 2019, and 2020, my last 3 years. So what I'm saying is, here's where I've been each of the last 3 years. And assuming I don't do anything dramatically different, where am I going, right? So if I look at sales, for example, there's some fluctuation. It ebbs and it flows, but it doesn't trend in a specific direction. So it's very easy for me to take that information and just average it. So that's my equation that I'm using. Just saying equals average, and I use the three numbers. Now I also use a round function in there, which is just saying, okay, to the nearest $1,000, right? I'm not going to be able to project to the cent because, things happen, right? But I want to know, give or take, if I don't do anything to my sales, I did 325,000 3 years ago, 315 2 years ago, 330 last year. I'll probably do around 320, 325 this year, right? Very straightforward. Now my service, if I'm looking back at my performance, I did 225,000 3 years ago, 252 2 years ago, and 276. So that's trending, right? There's a very clear trend of, okay, I'm going up every year. And the equation that I'm using there, it's a lot of numbers, but what I'm really doing is I'm saying, what's the average difference between the two periods? The average difference between 2018 and 2019, and 2019 and 2020. And then if I take that average difference and I add it to the most recent year, the trend will continue. So again, the same logic. It's saying, okay, if I don't do anything differently, I'm probably going to do a little bit more in service than I did last year, because that's what I've been doing. That's what my customers are expecting from me. That's what they're coming in and buying. So again, it's about 25,000 a year, give or take. So if I was at 276 last year, probably end up the year around 300,000. Commercial agreement, contract, I have that contract in hand. I look at it, it tells me the number, I plug the number in. Easy, right? Now, warranty, let's say I sell a warranty and I look back, and historically, warranty sales are 5% of my total sales. So 1 out of 20 of my customers say, yeah, I'll go for that warranty. I'm going to pay for a warranty as well. So rather than just project, a numerical value for my warranty, what I'm doing here is I'm tying that to my sales number. Because what I want to do really is say, okay, what if I change my sales number at all? What will that do to my warranty? And we'll talk about changes in a couple minutes. We'll pivot back to that. But when you're projecting, projections are useful to identify two things, right? It's useful to identify, where am I going right now if I don't do anything different? That's the first and most important thing to do, because then you're saying, okay, is this the direction I really want to go? If I can look ahead and I'm saying, well, it looks like I'm driving to Indiana. I don't really want to go to Indiana. I'd rather go to Philadelphia. I've got friends in Philly. So I need to start making those changes now, change my route, change my direction to make sure where I end up is where I intend to go. So that's the second part of projection, to say, okay, here's my map. If the destination isn't where I want to go, how do I change the route that I'm going to get to the destination I intend to go to? So as we build this out, the passive approach is to kind of lay it out and just say, inertia lines, trend lines, this is the direction I'm going. And then we can go back in and say, okay, I'm putting a lot of emphasis on my sales, and rather than expecting to do 323,000, I'm actually want to aim for 400,000 this year. Set that bar for my salespeople and really make that a priority for myself. My warranty is going to go up accordingly. Right? So I want to make sure that I'm tying that warranty projection to my sales number. Because if I put all this emphasis and effort on sales, my warranty is going to increase as well. And that's an excellent tool to use to understand, okay, not only am I increasing my sales by 75,000, I'm going to get a little bump out of my warranty too. So again, it's a very simple equation. All I'm doing is saying 0.05 or 5% times my sales number, right? So the result of this is now I have a year-end number. I'm looking forward, to the end of the year, the end of 2022 or 2021, and I'm saying, where will I be at the end of the year? Now, there's a lot of business in Maine that is seasonal, and that's very important to know from a cash flow perspective, right? So one of my clients a couple of years ago was a cruise line out of Far Harbor. And for 3 months a year, they had to do, over $1 million in sales to carry their costs through the next period. So that was an extremely seasonal business to say, okay, all of your revenue falls into 3 months. The other 9 months, all you're doing is spending, right? All you have are expenses with zero income coming in. So to be able to look forward and say, okay, where are your expenses? How much revenue do you need to make in that 3 months so that your bank account dips but never hits zero, right? So the seasonal variance is also important to project, and I'll kind of walk you through that. So a non-seasonal run rate is very easy to project, right? So if I go back a couple of slides and I say, my sales don't really ebb and flow. I hit the same number every month, and at the end of the year, it is what it is. So that's a very easy to project. All I'm saying is 323 divided by 12, right? So if my annual goal is 150,000, my January goal is 12,500. My February goal is 12,500, right? It is what it is. So seasonal, though, is more complicated. I'll walk you through kind of how to project that. So this is where historic value really comes into play. Because if you look back, what we can do is we can say, okay, what percent of your annual sales fell into January? What percent of your annual sales fell into February? And by doing that, you can actually map where revenue is strongest and where it's weakest for every revenue line. So it's that ratio of January divided by the total year that gets you to that. Kind of looks like this, right? So, you can see I peak in July and August, and I have a pretty slow winter. This might look pretty familiar for a lot of businesses here in Maine. And all I've done is I've said, okay, if my sales in 2020 were 13,800 and my total annual sales were 276,000, my annual amount was 5%. 5% of my total sales fell in January. February, same. March, the same. May, June jumps up to 10%. July, August, strong at 15%, and then kind of declines from there. So again, really strong in that July, August period. Now, if I change my annual amount, I go back, my annual amount changes based on my trend line or my expectation or something that I intend to do differently. I'm hoping that that seasonality remains exactly the same, but the dollar amount is going to be different. So all I would do would be to apply the annual seasonal factor against my end balance, right? So again, my seasonality weight times my annual amount is equal to my monthly projection. Understand, it's relatively complicated, but the idea is, if I'm weak in the winter and strong in the summer, I want my projections to be weak in the winter and strong in the summer. That's all it is. Right? We'll send this out. I do walk through these various equations and kind of show you how to do it in the Excel. So it'll be easy to reference and apply to your business, which is the most important part of this. I really want to make sure that you can do that with your business. Now, one thing to keep in mind, right? So I've looked back and I'm using 2020 seasonality for this. Now, your 2020 seasonality might be much more reflective of COVID than of your industry, right? So if you're expecting 2021 to be more of an industry standard ebb and flow, you can use the same analysis, the same kind of seasonal projection, but base it on 2019, right? Don't use 2020 if you think that ebb and flow isn't going to be replicated this year. Does that make sense? So, to kind of summarize this, documented contractual agreements, historical and relative, are all logical and they're pretty straightforward. I've laid it out in 15 minutes and I've already kind of covered it. And the whole concept is that, if where we were going is still where we are going, chances are we're going to get there. So if you don't do anything to change your trajectory, then that inertia will carry you forward. 2020 was obviously an exception. So keep that in mind as you're doing the calculation and trying to figure out this piece of it, where you're saying, okay, am I averaging 2020 or am I really looking at 17, 18, and 19 and trying to get back to that benchmark? Or is there somewhere in between? And is that historical trend is using, that 2019 to 2020 drop off? Is that a useful trend line? Or, should your trend be more trying to get back to 2019 and 2018? The SBDC, we do have some industry data about recovering industries, how it applies to Maine as well. So if you're curious about how long the expectation is for your specific industry to get back to where it was, please reach out. More than happy to share that information. So you can kind of, again, plot that expectation and say, okay, if it's going to take us 2 years to get back to 2019, that trend line is going to take a little bit longer, 3 years, 5 years, whatever it may be. Any questions so far? I think we still have a pretty small group, which is good for us because we can really ask questions as we go. And I understand, as a business owner, your time spent doing calculations and in Excel can be a little overwhelming. So, if you have questions about how to calculate that, this piece of it or the seasonality, again, please reach out. I know Jen mentioned at the beginning, SBDC is who I work for, who we work for, Small Business Development Center. We're a free service. There are, I think, 18 advisors throughout the state of Maine. We all do this regularly, and we're more than happy to work with you. So as fun as it is to kind of run through this from a top-down perspective, we much prefer meeting one-on-one with you and kind of going through it and making sure it's useful for you and you understand where your business is going. So this is a question that comes up a lot is, how do I project revenue for a business that's either changing, pivoting, being the key word for the last year, or starting from scratch, right? A new business, no historical value. If you're looking back and you're like, I don't have anything from 2018 or 2019, I've got a little bit from 2020. How do I know what to project? Again, we're going to talk about some strategies, right? So starting from scratch, I would start with an industry average or benchmark. And almost every industry has basic industry benchmarks you can use. So, a restaurant has turns per table or dollars per square foot. Salon or barbers usually have sales per booth that they can expect. Revenue per employee is very common for every industry. occupancy rate is very common in hospitality. So identify your industry and then find the appropriate industry average or benchmark. Right? So that'll give you a rough idea, just globally speaking. You know, if I've got 60 seats in my restaurant and I'm supposed to sell, 20,000 a seat, then I should be able to hit, 1.2 million or whatever the math is, right? So the idea being, if I'm in this industry, the average person in this industry of my size or my staffing should be able to hit this revenue as a benchmark. So that's regional, right? That's a national trend line or something that's publicized. I know occupancy rate you can find at the state level, but most of those benchmarks are national. Now you can also look locally, right? So go sit in your competitor's driveway or sit inside and count the people coming in and out. This is very useful for restaurants, coffee shops, retail. You can get a very quick idea of kind of the number of sales they're doing, the number of customers they have, who their customers are. You can look at their menu. Most menus, most retail sales, most pricing is very apparent. It's right on the website. It's right when you walk in the door. And then, one of the things you're kind of also identifying is when you're talking about competition, how do you compete with them? You can't compete with them on quality and price and timing. It's usually one of those things. So, if you're competing with them on price, you want to look at their pricing very, strictly and say, okay, if that's my goal is to be cheaper than this alternative, I have to be cheaper at almost every level. And am I, right? If your goal is quality, then really identify, okay, what are the products that are weakest that you can really improve on? So we'll go from there. Then there's a conversation of, okay, so you've identified a benchmark for revenue. You've identified kind of where you fit on that scale. How do you get there? Right? How do you get from where you are now, which is an idea or improvement, to that level, that average or where you want to be? So, we can spend, and the advisors do, we have whole classes on marketing plans, right? And marketing really boils down to two ideas. You're trying to convey so what, and you're trying to take that so what and convey it and communicate it to the who cares, the demographic of people that might be interested in your product or service. Right? So that's for a different time, but to really identify that and improve on that historical performance. So if you're talking about historic performance or starting from the ground up, it's understanding your customer. It's being able to say, okay, who is buying my product and service? What are they willing to pay? What do they get out of it? Why do they like it? And how can I improve upon that? If I'm looking at my my service revenue line, if I don't know who my customer is, how can I ever change that line? If you say, well, who's buying your service product? And I say, I don't know. It's whoever comes in the door. Well, how do they hear about you? I never asked. Then you don't know how your marketing is improving. So, one of the first things that even we do as SBDC advisors is when we meet with a new client, we say, how do you hear about us? How did you hear about us? It's a great way to say, okay, if I'm investing in Facebook and ads in the newspaper and I'm on Instagram and I'm going to BNI and I'm doing all these marketing efforts, but everybody just hears about me from word of mouth, why am I spending all this money, right? So it's a way to kind of identify what are the channels that people are coming across your business. And if you can identify those things very quickly and easily, it converts to saving you money ultimately and investing where that money is best spent. So when we talk about marketing, there's two primary approaches. I want to break this down. So passive marketing is kind of the indirect work you do to establish yourself, right? So that's blogs, that's referral networks, that's going to chamber events, that's wearing your shirt in public, that's the logo on the side of the van. That's just being first and foremost in people's minds, in your customers' minds. When they think, I need this product or service, do they think of you? Right? That's passive marketing. It's not direct. Now, active marketing is that act of direct communication with your customer. So that's the cold calls, the knocking on doors, the door hangers, that's the phone, that's paying for print ad to get right in front of them. You know, it all equates to finding new customers, right? And that's always going to be a more expensive way to get customers than keeping the customers you have. So that the passive marketing, part of that is maintaining customers and keeping that customer relationship, because it's always cheaper to keep a good customer than it is to go out and find a new one. But if you're talking about changing historic trend lines and saying, okay, I'm going to invest effort and energy and money into improving a revenue line, into increasing it, and I have to be able to say, okay, I'm going to do so by reaching out and talking to my customer base. I know my customer, I know what they want, I know how to communicate with them, where they go to listen, right? And I'm going to go there and talk to them, right? If I can get in front of them and tell them why they should care about my product, that's a customer I can get. So that's that active marketing. If you think you can just increase sales by not doing anything, you know, it's not going to work. You have to actually be out in front of them, talking to them, recruiting them to get to that stage. So how do you convert, in that projection sense, how do you convert active marketing efforts to sales? Right? So if I'm looking at my service, I did $325,000 in sales last year, and $320,000 in sales the year before that, and $330,000 in sales the year before that. How do I get that from $325,000 to $400,000? Right. So one of the ways that we talk about doing so is that active approach and using what's called a funnel. Right. So a funnel is showing you the effort you have to dump in the top of the funnel to convert to a sale. Right. So a marketing plan, when you talk about marketing plan, it's really talking about using multiple funnels, dumping in leads and converting it to sales, and then using that methodology and adjusting it as best you can to be as efficient as possible. This is one example of a funnel, right? So if I'm saying, if I make 32 phone calls in my Friday afternoon, and that 32 phone calls results in 8 meetings, and I can quote 4 projects out of it, and of those 4 projects, I get 1 new customer, right? That's my funnel. I got to make 32 phone calls to get a customer. Now, if that project that I just sold is worth $500 to me, and my revenue improvement goal, when I'm projecting forward, I'm saying I want to increase my sales by 5,000, you just dump that in the funnel, right? So that's, I'm saying, okay, I need to go out and get 10 new customers to get my $5,000 goal. I need to make 40 quotes, get 80 meetings, make 320 phone calls. I'm looking at that, I'm like, geez, that's exhausting, right? That's a lot of phone calls to increase by $5,000. So then you start working on, okay, how do I improve that funnel? How do, instead of being a wide funnel where I got to dump all this stuff in the top and hopefully get a sale out of it, how do I make that as narrow as possible, right? So that's where you kind of work on your scripts, or you make sure that the people you're calling aren't like the A's in the phone book, it's people who are actually interested in your product. So the more you can narrow that funnel, the easier it is to get the results you want, right? So if I can cut my phone calls in half, instead of 320 phone calls, I can make 160 phone calls and get the same result. So that's where that improving your performance becomes so critical. You say, okay, where of this aspect can I improve my performance? Or instead of $500, can I do $750 in sales? And then, I don't need 10 new customers to get my revenue goal. I just need 8. And all of a sudden, I have to make fewer phone calls. Again, how do I reduce the effort for me to get the same result? That's key, because you have money and you've got time. You probably don't have very much of either as an owner. So the only way to improve sales effectively is to measure it and say, okay, where is my effort best spent? So, when we talk about pillars, it's like legs on a stool. You don't want just one pillar feeding your business. You really need a couple different, you need phone calls, you need the referral network, you need social media these days is incredibly important. BNI, newspaper ads, you know, I include a whole list of things you could probably work through. What are your competitors doing? What's effective for them? How can you differentiate yourself from them using other methods? What's effective for you, right? Go back to that question, you know, how did you hear about me? Right? That's so important, because if you're making 320 phone calls and every time you talk to a customer, they just say, yeah, you know, I saw you on Facebook, you know, save yourself some time, you know, do a few more Facebook posts, right? That's working, that's effective. Do what's effective. So really, you know, identify the pillars. We talk about a 90-day window for marketing. Say, okay, is the results you want, that revenue increase, is that really due to a marketing effort, or is that due to, you know, some other correlation that's not actually causation, right? Is it some other influence that's just resulting in a slight bump in revenue? So doing it for 90 days kind of allows you to measure that effort, put in the effort, and then measure it and say, okay, is this having the impact that I want? Is this having the results in my bottom line that I think is important? So do these things, measure them, right? A marketing plan is really a calendar. It's saying, we understand you can't make 320 phone calls on a Friday afternoon. Can you do 10 a day for a month straight? Yeah, that's pretty exhausting too. 320 phone calls is a lot. You know, this is an extreme example. But being able to break it down and saying, okay, I'm going to do 5 phone calls a day. And for the first 2 weeks, I'm going to do it in the afternoons. And for the 2 weeks after that, I'm going to do it at my lunch break. And for the 2 weeks after that, I'm going to do it first thing in the morning. And I'm going to measure this ratio. I'm going to measure this funnel and say, okay, people are more receptive first thing in the morning. Right? So now instead of 320 phone calls, I can do it in 200 if I just target the morning. Right? So again, it's that iterative process. It's that measuring. It's that consistent improvement of saying, what is effective for me? What is actually changing my revenue line? Because ultimately, that's the most important thing. And so that measuring, to take a step further, you know, cost per customer is something that you should be aware of. And each one of these pillars has a cost per customer, right? So, you know, a couple of examples I threw out there. You know, if you spent $600 last year on a referral group, a referral network, and you got 15 new customers, then you paid $40 per customer, right? You spent $150 on 2 newspaper ads and you had 2 people call in, you know, you get, you know, it's $150 per ad, right? So it's $150 per customer. So right there, I can say, you know, maybe newspaper ads isn't the best source of customers for me. Maybe it's my referral group, right? Because I'm paying much less per customer. But being able to,
you do have a question. What's BNI?
BNI is, shoot, now Jen, do you know what it stands for? It's Business Network. So it's a national group that meets with professional networking. There's a BNI chapter out of Portland. I believe there's one out of Auburn and Lewiston and one out of Bangor, I want to say, or Augusta. But they meet bi-weekly or monthly. It's usually like an accountant, an attorney, a realtor, a number of other professionals, and they are trusted professionals that work together to identify customer needs and make sure everybody's taken care of. It's kind of it's an example of a referral group. There are also referral groups that are more organic and less structured. I know BNI has a very specific schedule that they go through every single meeting. But it's, you know, the idea is, where are your referrals coming from? Can you identify it? Can you work with them as a pillar, right? You know, are you getting a lot of customer referrals? Do you get vendor referrals? Do you get competitor referrals, you know, from other markets, you know, bringing business in? And if you don't, you know, how can you improve that? How can you generate more referrals from that? Yeah, the chamber is a great place to start. Thanks, Christine. You know, retail service business, the Chamber of Commerce is always a good referral group to be a part of. Or just interact with your business community. So a couple things to keep in mind, just keep asking, how did you hear about us? Interact with the customers. It's a good way to understand where your money's best spent. Include your labor cost in this, right? So if I go back to my phone call example real quickly, I look at that, and you might look at this and say, well, this doesn't cost me anything. I'll just do that a lot. 320 phone calls, that's going to take you hours and hours. Right? Your time is worth something. So to really get that kind of apples to apples comparison of where is your money best spent, make sure you're adjusting for your labor, right? Because you have two things. You have money or you have time, and both are finite resources. So if all you're doing is your time, that's okay. A lot of small businesses, that's what they rely on. But make sure you're adjusting and you're saying, okay, maybe it's not cost per customer that you're equating this to get like an apples to apples comparison. Maybe it's minutes per customer. Maybe it's hours per customer. Right? If you do 320 phone calls and you do, 10 minutes a call, what is it? It's like 5+ hours, right, to get 10 new customers. So you're talking about a half an hour per customer. How does that compare to other efforts that you're undergoing? Make sure you can compare those things. And then one last factor that kind of gets overlooked in this a lot is, where are your most valued customers coming from? So all we're talking about right now, today at least, is really identifying that revenue line and say, okay, how do I project my revenue? But if you're working twice as hard and all of your customers are difficult, and you're seeing a 10% increase in revenue, is it worth it? Right? Is that the type of customer you want? Is the funnel you're using attracting the customers that you want the long-term relationship with? Or are you driving revenue by working 3, 4, 5 times as hard? And that I see that a lot too, actually. If someone say, yeah, I'm working twice as hard, but I did 10% more in sales. It's like, well, once you add in cost of goods and expenses, you're working twice as hard for 50 cents more an hour. Is that really the effort you want to undergo, or is it more you should be trying to keep that core customer base that you really like working with and really refine your product and your service? So there is an aspect of that to this, where you're saying, okay, yes, the numbers make sense. Yes, I can project the revenue. Yes, this all makes sense. Yes, I can, get my business from where I am to where I want it to be. But is it worth it to me as a business owner with finite money, with finite time in my day? Is this, is the potential for burnout and the exhaustion that goes along with this trend change worth it? Can't discount that enough. So we're ahead of schedule, but some tips and afterthoughts, right? So it always helps to kind of be conservative in your estimates and assumptions, right? I'd much rather be pleasantly surprised than unpleasantly shocked. I'm sure your commercial lender feels the same way, and your employees probably feel the same way. So, if you set a low bar for your employees and they exceed it, and you have to praise them and give them a little bonus, that's not the worst thing. If you set a low bar for yourself and you are pleasantly surprised, that's not the worst thing for yourself either, especially after the last year that we've had. So there's a mental and emotional part to this as well that I don't want to overlook as much as I like just the numbers. And you can change your projections. That's one of the things with projections that is kind of fun as you go through 30 days, 60 days, 90 days, and you say, I can do better than this. I'm going to change my projections. I'm exceeding my own expectations. Let me improve. So once you put those projections down, two things with that, right? As a business owner, you don't really have anybody to hold you accountable, right? Until you start bouncing checks and aren't able to make payroll, nobody's looking over your shoulder. You're pretty much free to do whatever you want. So one of the ways that we encourage business owners to hold themselves accountable is through this projections process, right? Not only the revenue is critical to a business, but the expenses and understanding your cost of goods margins and everything is important as well. And at the end of every month, there's really two benchmarks that an owner can use, right? So it's projections to say, okay, here's what I did and here's what I expected to do. And it's not just the numerical value that's important there. It's the cost per sale or the, the value per customer or the ticket. There's every industry has its own benchmarks that you can use to say, okay, am I improving above where I expected to be? And then the other benchmark is against prior year. To say, okay, am I doing better year to date or for the month of April than I did last April or for the last 4 months of last year, right? And hopefully given last year, that'll be a given. But those two benchmarks really allow you to check yourself every single month. You close the books, you reconcile against the bank account, and you say, okay, am I doing better than I expected? And am I doing better than last year? If you can answer yes to both of those questions, that's great. That's as much as you need to do with the numbers. Move on. Keep doing the operational stuff, the human resources stuff, the marketing stuff, all the other hats you have to wear, right? But if you miss one of those things, if the answer is no to one of those questions, being able to quickly identify why not? Where am I missing? Is it a specific revenue line that I need to focus on? Is it my sales per customer went down? Why did you miss? And if you can identify that quickly within 30 days, 60 days of it happening, rather than at year end or when there's no money left in the bank account, you're going to save yourself so much stress and headache in the long run. So that's the other advantage of projections is you're really saying, I want to be in the driver's seat for my business. I'm really tired of backseat driving and hoping we get there and, are we stopping for lunch? I don't know. Let's just keep driving and see what happens. Once you put projections together, you're saying, I'm taking control of this business. I am planning where we're going to be and how we get there. As long as I keep my eye on that goal, and I understand the adjustments I need to make along the way, then we're going to get there. And that's, from an emotional perspective as a business owner, that's so much more gratifying than just ending up in Indiana somewhere and saying, well, I thought we were going to Philadelphia, but, I guess this is close. Learn your industry benchmarks. That's another little tip. It's very easy. If you're having trouble with that, please reach out. We can look that up for you. But it's an easy way to say, okay, is my cost of goods margin in line with where it should be? Why or why not? Are my inventory turns, reflective of the industry? Can I do better? What is everybody else doing, and how close am I to that? Am I doing well or poorly? It's another way of kind of holding yourself accountable. Okay, how do I measure my own success other than just checking my bank account and making sure there's some money in there? Ask, how did you hear about me to everybody that you speak to as a customer? Right? That's so critical in understanding those first two questions of a marketing plan. Right? Who cares? So what? That how did you hear about me should drive where you're spending your money, where you're investing in your marketing. All of your advertising dollars should really hinge on your customers' answers to that. And then measure, right? Measure. Measure your performance. Double check it. If you think you know your ratios for your funnels, try to improve them. Change something. And if it does better, then that's great. Stick with it. And if it does poorly, then switch back, right? So it's a way to kind of, every time you change a variable, measure it against where it was. And as long as you can do that, those little iterative differences, you're going to really improve your business as a whole. And it's exhausting and it's ongoing, but that's being a business owner, right? So, any other questions? Anybody want to hop off the chat and do that?
There's a couple of good comments and some questions coming in. Somebody noted that a mistake they made in the beginning was thinking that they would make better profits down the road and kind of trying to figure it out later, which I think is probably fairly common with business owners. So I think, thanks, Tommy, for noting that. Okay, This will be available, the recording and the slides, and we'll send out a follow-up email in the next couple days. Just another question we had.
Great question. Gemma had a great question. Sorry. So
regarding the marketing slide, why are website posts passive and social media posts active? Is that the one you're talking about? Sorry.
Yeah, no, it's a good one. So it's kind of how I identify it, and you might treat it differently. So website posts, from my perspective, are a good way to increase search engine optimization, right? So it's that establishing yourself as the trusted professional. So if someone goes out and searches for your service or the product that you provide, is your name first? And if they click on that website, do they see, wow, this person blogs about this, they live it, they breathe it, they love it. This is the person that I trust to give me that service or product. So you're not actively recruiting the customer. You're just presenting that professionalism, right? So that, to me, that's the distinction. Now, social media can be both. So if it's paid social media, then you are identifying a list of potential customers, right? So you're using Facebook, or you're using Instagram, or you're using Twitter, and you're saying, I want to target women between the ages of 30 and 45 that live in non-Portland, Maine, right? So you're identifying the geographic region, maybe socioeconomic status, gender, whatever you think your customer is, and you're paying to reach out to them. Now, the message might be very similar. Right? The message might be, I'm the professional, here's the service, here's the product. You measure it differently, though, because when you're paying for it, you can follow the clicks, and you can say, okay, pay per click, right? I paid $20 for this, I got 200 clicks. So I paid 10 cents a click. Of the 200 clicks, I got 5 customers, so I paid, $4 per sale. Now, if my average sale price is only $3, maybe I need to take another look at that. But if my average sale price is $50 and I paid $4 per sale, okay, and hopefully I can keep that customer. Now that customer's used me, they're familiar with me, they like me. If I don't have to pay for them and they come back 6 months or 3 months or a year later and buy my product again, that's that passive marketing, right? So once they purchase from you, are they revisiting your website, right? Are they aware of you? Do you keep in contact with them? Do you reach out to them for additional promotion? Do they refer you? Do you give them a discount for referrals? So there's a lot of ways to kind of incorporate those two aspects to your marketing. Active, though, in my perspective, by my definition, is when you actually pay to reach out and speak to someone, where you actually take the efforts to be active in that approach. So it's more targeted. Right? So passive, you're presenting yourself, you're working on that image, it's the customer relation, you're available. You're reminding all of your old customers that you still exist, that you're still the person to go to for that. Hopefully that answers your question.
So somebody mentioned, while we're talking about getting new customers, they would love to know more about digital marketing. We do here at the SBDC have several upcoming digital marketing focused webinars. Those should go right through the summer, so keep an eye on our calendar. But I also want to let you know that we have specialists right now through September that can meet alongside you and your advisor to talk about those sorts of things. They're digital marketing specialists that can really target which digital marketing efforts would be most valuable for your business, because I think that is something that varies by business type and industry. And so certainly reach out to your business advisor if you have one. And if not, we will include information on contacting or getting in touch with a business advisor. Because I think one of the best things that Raynor didn't cover so far is that when you work with a business advisor, you don't have to just work on your financial projections. They can help you look at the overall picture of your business and talk about maybe what efforts, in marketing, or, if your cost of goods is too high, why you're not making that profit, or your pricing. All of these things you can work with alongside a business advisor at no cost. And we have one more question that I see. Would you suggest adding a "how did you hear about us" as an opening slide on the website, or how would you suggest they collect that information via a web presence?
Good question. I'd shy away from that because on a website, you really have, I forget what the exact number is, between 3 and 5 seconds to get them to click where you want them to click. And you usually only have one major goal of a website, right? So it's either to get them to your, to buy something, or to get them to contact you for a quote, or, to schedule a time, right? So that really should be the focus of your website, is to drive the actual sale. That said, how do you collect that information from the website? You could offer it later in the website as part of a survey or as part of their checkout cart. So by the time they've already committed to purchasing something, it's in the cart. You could add a question or two, maybe offer a small discount or free shipping if you answer these 5 questions, something like that. But yeah, my fear of using a website to ask that question would be that it would distract from the ultimate goal of the website. Right? So you could, but I think it'd be more effective to kind of bury that lead a little bit deeper, or reach out after they purchase and then ask.
Are there any other questions?
Great question.
Definitely.
Great. Well, I'll let you all go like 8 minutes early on this beautiful day. So go enjoy it. My contact information's here, and then if you don't know who your advisor is, I included that link as well. So please reach out.